Hello, everybody. This is Luke McCarty from McPherson Financial Group. Thank you for joining this video today. It is September of 2021. We're going to go over our recent portfolio trades we made last week for you and the reasons why. What we're doing is we're adding more bond alternatives to the portfolio. Bonds are negative for the year, so we want to get out of bonds, but without increasing your risk, and we'll show you how we're doing that. But first, our economic indicators. If you remember our Q2 video, civilian labor force was negative. However, from a year-over-year basis, now unemployment is below what it was, so that is now green. However, real personal income turned negative because of inflation. So when we see inflation kind of eating into our income, that's where the real personal part of it comes into it. Housing starts are actually trending down. Retail sales are trending down. So we have a few things to be cautious of, but when two of these are negative, that's when we look at being more cautious. If three are negative, we reduce risk. So we're watching these for you guys and for you and your accounts. And this is how we make our investment decisions. Portfolio changes. So we increased our position in Swan. It is an ETF that we currently hold in these models, but we increased it in the below models. We also increased our position in JPMorgan Hedged Equity in our conservative 30 model. What is Swan? So Swan, like I mentioned, is an ETF. So it is 90% treasuries and then 10% S&P 500 options. So every 6 months, the option will be rolled to the following year. If the options are at a net loss, they rebalance the month. If they're at a gain, the rebalance occurs 366 trading days from the option to make the gain long-term. So very tax efficient from an options perspective and a very low risk because you're 90% treasuries. This is how Swan has performed versus the S&P 500 since 2005. Swan is in the red, the black is the S&P 500. So if you look at it from basically 07, 08 to, gosh, almost up to 2016, the black swan's ahead, and then the S&P kind of goes forward. And then when the big dip, right, end of last year, or end of 19, I should say, the S&P kind of started taking off a little bit, but we are not trying to outperform the S&P 500 with this. We are just trying to outperform bonds. So this is definitely outperforming bonds if it's keeping up with the S&P 500. Our next bond alternative that we're adding to, you currently own this in these models that I showed you earlier, is JPMorgan Hedged Equity. So we're using this as a bond alternative. What the Hedged Equity does is it owns the S&P 500 stocks and it writes options on the downside. So in between A and C there, you see the first 5% loss of the market. You as the investor, you take that loss dollar for dollar, so you could be down 5%. However, anywhere from -5 to -20, you're still down -5. So back in March of 2020, when the S&P was down about 19.8, this was down about 4.9. And so you basically don't take the full brunt of the downside of the market. And then what's the catch, right? The catch is if you're reducing the downside risk, you don't get all the upside of the S&P 500 either, but you have a cap. So the cap usually is in the 4.5–5% range. However, that's quarterly. So this resets every quarter within the market. Our market outlook. So we are currently still believe we're in a secular bull market that tends to last 15 to 20 years. So we started in 2009, so there's still time. That's why we're kind of seeing the market melt up right now. And it's kind of getting a little boring. I hate to say it on recording, but that's kind of what's happening at the moment. We're kind of just trickling up. When the S&P 500 has been the top performing index, it is difficult for a diversified portfolio to outperform. In all of our portfolios, we own US large cap, right? We own mid cap, we own small cap, we own some international. If we're adding bonds to the mix, right, we have bond alternatives, we have hedging strategies, we have high yield bonds, short-term bonds. We just recently added in, Treasury inflation protected securities tips. Hopefully you saw that email. But we believe the 40-year bond bull market is over. AGG, if you look up that ETF, the bond aggregate index is negative 0.84% year to date. So now what we're seeing is safe money. What bond money has been historically considered safer than stocks. is negative, and inflation is running about 4.5–5%. So we don't want too much money in bonds at the moment. We can't get rid of all bonds, but we can move some of them out and still keep the same risk profile, if not even lower your risk. Thank you for joining the video. If you have questions, call us 321-253-2016 or email us, Luke and Art. There's our email addresses. And then here are our disclosures. Thanks again for joining. Call, email with questions.